Thank you all for joining the Ask the Experts webinar. Today we have Eric Bregman, Steve Black, and Chuck Earney to talk a little bit about accounting and things you need to know as a board member. So as a reminder, we do record this session and we do hope you will tell your board members to watch it. We do post it on our camsmgt.com website, and it will be posted with all of our other webinars that we host on the third Thursday of every month. There are probably close to 35, 36 different webinars. So if you're interested in checking out those webinars, you can visit the CAMS-MGT website under board member resources and find those webinars. We will facilitate questions at the end of the webinar, so feel free to type those questions into the Q&A feature at the bottom of your screen, and I will help read those questions to our experts this afternoon. So Eric is going to start. He's with Earney and Company, and then we'll have Chuck and Steve talk about a number of accounting related topics today. So Eric, I'll turn it over to you.
Thank you. So good afternoon. My name is Eric Bregman. I am an audit partner at Earney and Company and am the practice leader for homeowners associations here at our firm, handling audits, reviews, compilations, as well as a large number of tax returns that I'm also responsible for. We get to talk about some fun accounting stuff today, so we can go ahead and on to the first slide. So the first thing that I kind of want to talk about is why you would want to have a relationship with a CPA. There's a number of reasons, but the main reasons is to have a trusted advisor that you can go to. As a member of a board, you want to be ensuring that you are fulfilling your fiduciary responsibility, and having a trusted advisor such as a CPA by your side is a good move. We provide you a big picture view of things. We tell you how it is. We tell you what the numbers say. No emotions or politics involved. We are also independent. So we are the only people that can provide an independent assessment of how a board is doing from a financial perspective. And to be there as a continuous trusted advisor can provide some clarity to homeowners. All right, we'll jump on to the next slide. So we're going to talk a little bit about financial statements of homeowners associations. They are definitely different than a lot of organizations. They are kind of a hybrid between governmental accounting and for-profit accounting. So the main things to note on financial statements, first of all, fund accounting. There's three main types of funds that you'll see in a financial statement of a homeowners association. You have your operating fund, which is what your annual budget that you approve each year is your operating fund. That's your basic revenues and assessments that you collect, and general operating expenses that you have during the year. Those are the least restricted funds that you have. Non-capital reserve fund, or a board restricted fund, is a fund that is set aside by the board of directors for a specific use, such as insurance deductibles or storm cleanup or something like that, where the board sets money aside for money to be used for a specific purpose. Then you have your capital reserve fund, which is your most restricted, which the funds are used for capital repairs and replacements. They cannot be used for non-capital reserve function or operating function. They are there specifically for your capital repairs and replacements. So what are reserves? One of the questions that a lot of people have a hard time struggling with is what reserves are to the average homeowner. So typically, the way I like to try to simplify it is reserves are essentially mini savings accounts that money is contributed to each month and each year, built up to be used specifically for repairs, replacements of capital items. The key to note here is that HOAs are supposed to spend money. They're supposed to use those funds to ensure your common property is up to date, that your amenities are in good shape, that your ponds are in good shape, etc. A lot of people think that an HOA is not supposed to spend money and supposed to save all the money, but the reserves are specifically for spending money. And how do we know how much to save for a reserve? Well, that's where the reserve study comes into account. A reserve study is probably the most important tool that you can have to figure out your plan over the next 20 to 30 years about when your capital items might need to be repaired or replaced, and you can fund your reserves accordingly. The reserve study is extremely important. Every association should get one at least every 3 years to make sure that they have the most up-to-date information to be used as a tool. But just kind of in summary, with reserves are funds that are supposed to be spent for capital repairs and replacements. That's the whole entire point of them. Prepaid assessments, this is when you pay for, or homeowners pay for their annual assessments or quarterly assessments in advance. They will show up on a HOA's balance sheet in the liability section as an assessment to be earned in the following year. All right, we can go to the next slide. Property and equipment. So this is another item that tends to cause some level of confusion. Property and equipment. So there's two types. You have your common property, which is not capitalized. Typically, anyone that's looked at any sort of financial statement of any kind has seen property and equipment on the balance sheet. Typically with HOAs, that is not the case. Common property is expensed as it is purchased, repaired, or replaced. It does not show up on the balance sheet as a capital item. Personal property is capitalized. So that would be, the best example I can give is if an HOA owns a truck that they use for whatever reason, that would be shown on the balance sheet as property and equipment because the association owns the property. It is not common use property. So that's one big misconception that a lot of people have when they look at a balance sheet of a homeowner association. So there's a couple disclosures in an audited financial statement or a CPA prepared financial statement that I'm going to talk about really quick. One is the reserve disclosures. So CPAs are required to disclose in a financial statement the future repairs and replacements, which lay out the reserve items contained in a reserve study, the estimated cost to replace over the next 20 or 30 years, as well as the current levels of funding of the reserves. The interesting thing about this disclosure is we are required to put it in a financial statement, but we cannot opine on that. We have to disclaim an opinion, but it is a required disclosure. It's an extremely important disclosure. I think it's probably the most important thing that you can have in your financial statements because it provides the board as well as homeowners some transparency into what's coming up and what they need to do to properly plan over the next 20, 30 years. The next important disclosure that I kind of want to lay out here is insurance. At Earney Company, one of the things that we ensure that all HOAs disclose is their insurance coverage specifically over common property and personal property to make sure that the homeowner can see that the common property that you do have is properly insured and what those levels of coverage are. All right, we can flip over to the next slide. All right, so let's talk about assurance services that a CPA can provide to a board. There are 3 levels. A lot of times people just assume that an audit is the only type of financial statement that a CPA can provide. There's really 3. And a lot of times people lump the 3 together and call them audits. So we just like to call them CPA prepared financial statements. So the first level is a compilation. This is basically where we prepare the financial statements, provide a set of footnotes. This will provide you a balance sheet and income statement, statement of cash flows, as well as all the required footnotes, your reserve information, and the insurance information that we talked about before. There is no level of assurance provided that those numbers are correct. We just compile them into a nice set of financial statements, and then you have those to be able to look at. A review is the next level. This is where we also prepare the financial statements, the same as a compilation. But what we do here is we perform analytical procedures, and we do inquiries of the board, of the management company, of the accounting department, to get questions answered on, why things have fluctuated, why things have changed, what is this, what is that, so that we can provide a moderate level of assurance on your financial statements. Then there's the audit. Audit, of course, is the most assurance that we can give. In audit, we obviously prepare the financial statements. We also do the same analytical procedures we do in a review, but we also do a risk-based audit according to generally accepted accounting standards, auditing standards. We review internal controls. We review IT controls. We do verification procedures such as confirmations, such as testing of invoices, et cetera, et cetera. And we also, like I said, provide the financial statements with the full set of footnotes. In addition to that, we also have an internal control letter that is issued with an audit. And there's also a letter to the board of directors explaining what we did during the audit. So those are the three levels. One thing to note about the reasons for an audit, we can go ahead and flip over to the next slide here. So let's talk about what an audit is and what an audit isn't. So an audit is independent set of eyes to make sure the board is doing what they're supposed to, shows the board's commitment to transparency, but most importantly, it assists with financing. So if an association is looking at potentially taking out a loan, or already has a loan that has a requirement for an audit, has a special assessment that they have where they need to show some transparency that that money is being spent in accordance with that assessment, that is what an audit is. That is what an audit does and what it assists with. What an audit is not, and this is another common misconception, an audit is not an audit of the management company itself and its systems. We are not auditing CAMS. We are not auditing CAMS internal controls. We are auditing the association. It is also not any sort of forensic assurance, nor is it a search for fraud. So that is what an audit is not. So we can go ahead and flip over to the next slide. Okay, so I'm going to go ahead and turn this over to Chuck Earney, and he is going to talk some about compliance and some HOA tax related matters.
Welcome everybody on this event. Many of you are board members and are paid huge sums to serve on a board. Now, I know you aren't paid to be on your board. You're protected by state law if you're a volunteer on a nonprofit board. So you have that in common with all nonprofits. You're a volunteer board protected to some extent under state law. You still should have directors and officers insurance. You need a CPA to help you and part of your team on a very important subject, how to deal with the IRS. As Eric indicated, we can do services with financial statements. CAMS does a lot of oversight on keeping you in compliance with all the regulations of state law, but you as a board member have to annually approve the type of tax return you file for a homeowners association. A homeowners association, if you go back and look at how you're incorporated in North Carolina as a nonprofit, which in itself sounds like, oh, we don't pay any taxes. Nonprofits are many different categories, and there are about 20 or 25 different mailboxes that you can qualify as a tax exempt nonprofit. HOAs are a peculiar of their own in general. We have a very small number of HOAs who qualify to be a 501c4, which is one mailbox the IRS allows for not paying taxes. St. James in Brunswick County is a 501c4. It's a community. It's basically a government entity, and it supplies only streets and common areas, doesn't do any maintenance of homes and residences, and it's a very tough exemption to get, but we have a few of those type of clients. Some of the homeowners associations we work with have clubs, golf clubs, marinas on their campuses or on their facilities. Those are 501c7s, which are not homeowners associations. They're clubs under a different set of rules. We're going to focus on HOAs in North Carolina. And in North Carolina, you can choose annually one of two ways to be taxed. You are not exempt from income taxes. You're organized as a homeowners association to collect assessments and spend them on whatever a normal homeowner would spend to maintain and keep their property up to date. So insurance probably is one of your biggest expenses, as well as maintenance of properties and so forth. And in general, when someone is looking at how you're managing your organization, people that lend money to HOA owners usually like you to have a 90% of your budget for reserves and I'm sorry, for operating expenses and 10% roughly for reserves. And as Eric said in his presentation, you're organized to spend that money and not accumulate except for reserves. Our financial statements, as Eric's gone over, are not considered regular nonprofits. There are the special rules. The CPAs and the tax code have special rules just for HOAs, and that's what I'm going to cover in the rest of my part. The first, the next page is, if we could go to the next slide, it'd be great.
Hey, Chuck, if I may, you were commenting on North Carolina. We do have some board members from South Carolina with us. Would the rules be any different on South Carolina communities?
We do South Carolina also, and in general, no. In general, they're the same.
Steve, can we go to the next slide, please?
So one way, and this is by far the majority of our tax exempts, have what is called the short form, the simplified form, the Section 528 form. We love this form. It's easy to prepare. And what you pay income tax on is what a homeowner would pay income tax on if they did it in their home. For example, if you as a homeowner saved money to replace your roof and you kept it in an interest-bearing account, you would fully expect to have to report that income on your tax return. Same for HOAs. Interest income is, and especially with the favorable trend in interest rates, has become the main type of income that is non-taxable. If you rent out part of a room above a garage as a homeowner, that's rental income, you'd have to pay income tax on it. If you advertise with a billboard in your front yard, or as a homeowners association, you sell space on your website, or you give exclusivity to certain vendors for a price, that's not under the exempt income for a homeowners association. So these things that are not related to maintaining the property could be subject to income tax on this form. And that's kind of the way the tax law works. If it's for maintaining the homes and the properties you're managing, that's exempt generally from taxes. But these kind of things that you would pay income tax on if you were privately doing it are subject to income tax. The rate on this, we can go to the next slide. The rate on this, any profit you would earn is 30%. So it has a 30% tax on the non-exempt income. To qualify for this short form, which is a very favorable form because it has a very, very low risk of IRS audits. I don't think we've had one audited the biggest problem people have is not filing it and having to catch up on it. But if done properly, has a very low risk of audit. To qualify, it has to be a residential association. 85% or more of the homes or lots have to be residential, not commercial. You got to spend, a requirement is to spend annually 90% or more of your assessments. As I said, you're taxed on non-exempt income, low audit risk, simple form for those of us experienced doing them. We highly recommend, if you qualify, using this form. Tax rate is a little higher than the other form, but until interest gets very high, it's so simple to prepare and so low risk of audit. We generally recommend this form. Go ahead to the next slide. The other option that you have is IRS codes 277, designed specifically for homeowners associations. You make an annual choice. It's called a long form. And if you're going to save significant taxes because the rate on this is lower, it's only 21%. So that 9% differential, if it's saving you money, like probably if your interest income is $5,000 to $10,000, it may benefit you to do the long form. It's more complicated, it takes more effort and costs more to do, but it would save you taxes. The biggest concern I have whenever we look at this is you have to have handled your reserves properly. Your CPA can advise you on if you're handling your reserves properly. Eric went over some of the requirements, a reserve study, keeping the money separate, etc. But you have an exposure if you don't handle your reserves properly on this filing, that the IRS comes in and says you did it all wrong and you owe us back taxes on all your reserves, which we would do everything to prevent that from happening. But it's tempting to the IRS because you have a bucket of cash to pay the tax, and it's tempting to them. So this form saves taxes, more complicated. You have to assess the risk of filing it, whether you're doing everything properly from the reserve standpoint, but it's the other option you have, and we are glad to help you make this choice. Next slide. And I'm going to turn it over to those in the know on legal matters. Steve, do you want to take over?
All right, well, good evening, everyone. Turn my video back on. Well, All right. Well, you may not get to see my face then. Good evening or good afternoon. My name is Steve Black. I'm a lawyer here with law firm Carolinas, and I'm going to be kind of taking what those gentlemen said and kind of putting it to where the rubber hits the road. That was a lot of great, high knowledge on things. What do we do with it? What do we do with it as a board of directors? So, just a little bit of background on me. I have been on my board of directors of every association that my wife and I have lived in for the last 30 years. I've been the president, vice president, treasurer, secretary, member at large, committee member. So I've seen it all from your perspective, which I think kind of gives me a unique lens to look at things through. And so I kind of know what I was worried about when I was on the board of directors on what my duties were, how much trouble I can get into in serving my association. So that's kind of what I'm going to cover here initially. So with everything that Chuck and Eric brought up on the accounting side, I want you to plug it into this idea, okay? Every board of director has to use the business judgment rule, okay? That's the standard that the law has set for volunteer board of directors of homeowners associations and any other nonprofit, is business judgment rule. What does that mean? That means that when you make a decision on whether to have a compilation, whether to have an audit, whether to, what you're supposed to do with certain provisions of your restrictive covenants, the law expects you to use good business judgment, okay? Now, let's give an example, because where boards kind of get hung up on this sometimes is, well, this is a volunteer position. I'm dealing with my neighbors and sometimes my friends, and so I may be a little skewed in my judgment on which way I want to go on something, okay? That's where the trap is. Okay. In other words, when you make a decision as a board member, it's a business judgment decision. You are running a business. Some of you have budgets of hundreds of thousands of dollars. Some of you have $1 million budgets possibly. And so it's a serious thing, and the courts expect you to make good business judgment decisions. Okay. An example of that might be, well, we want to save a little bit of money, and we want to use Cousin Bob to cut down those trees that came down in the storm the other day. And, Cousin Bob, I've known him forever. He's a family friend of ours. And let's not get any other bids or quotes. Let's just let him come out here on Saturday and get all that wood up. Okay. Is that a good business judgment decision? Probably not. Okay. I don't know your cousin, but unlikely. Let's get a professional in there that's insured and bonded. The next standard as a board member you're expected is you have fiduciary duties, okay? The reason you have fiduciary duties is because you're dealing with other people's money. People pay their dues into a pot. You have the operational account and the reserve account, as Eric mentioned, and you have a fiduciary duty over those funds, okay? So it's a little bit of higher standard of care over even what you would do with your own finances. So the law does expect you to think twice when you're talking about spending money and possibly getting loans and that sort of thing, which we're going to talk more about later. You have to act in good faith. Okay. Now there's a very broad phrase, is what's in good faith? Well, it's easier to tell you what's bad faith. Okay. Bad faith is when you are doing things that are not in the best interest of the company. Okay. When you're not following the restrictive covenants. You're not enforcing the restrictive covenants. You're not attempting to amend them if you don't want to enforce them. So bad faith is easier to define as good faith. Good faith really is you're doing what's in the best interest of the company. Okay. When you're sitting around that dining room table at Sarah's house and eating brownies and having some coffee, it may seem very informal, but again, business judgment rule, fiduciary duty, and you got to operate in good faith. Okay. So that's kind of the box, the standards that you need to keep in mind as you're doing all of this stuff. Now, you may have the best professional management company. You may have great lawyers that help you. You may have great CPAs that help you. At the end of the day, the buck stops with the board of directors. Okay. The way you prevent getting into trouble is go to the experts. Okay. Get a good CPA, use a professional management company, use, experienced lawyers, use experienced landscapers, use experienced engineers when you need them. Go talk to the experts. Go talk to the people in the industry to help you. I can't tell you how many cases I've had where the board said, you know what, that engineering report is going to cost $2,500 to see if Margaret's deck is okay over there in the condo. That's a lot of money. We don't really want to spend that kind of money. So what's the alternative? The alternative is for the board of directors to guess at whether that deck is okay or that balcony is okay. Probably not smart. Okay. And so the buck stops with the board of directors in the end. It's your decisions that count. And I'm telling you, the best way to protect yourselves and this association is use experts. When you need them, use experts. That's one of the best defenses we have when we have litigation, is that the board has used experts. All right. I just threw this one on the bottom here because I have a current case on this. And I thought, you know what? I don't think the board saw this coming. So avoid at all costs the risk of appearance of self-dealing. What does that mean? That means that you got on the board of directors, or it appears you got on the board of directors, so that you can get your fence approved, or your shed approved, or your neighbors, your buddy, your friend's shed approved, or so you can maybe go back and, you know, dish out some personal justice on the neighbor 4 doors down whose dog barks all night. Okay. Got to be careful with those things. Okay. Now, those are some obvious ones that, of course, we don't get on the board to do those things. That would be clear self-dealing. What about a dinner where the board meets together for dinner and the association pays for it? Is that some kind of self-dealing? I mean, is that kind of, it's for me, it's about me. I get a benefit from this association that nobody else gets. Just be careful. Keep that on your radar. Okay. I'm not saying that that's completely inappropriate, but it certainly doesn't look good. All right. Next big question that keeps coming up, I thought it would fit well with the CPAs, is what financial records are owners entitled to see? Okay. What books and records can any member of the association ask for and see? Now, there's two things here that are important. Number one is most governing documents of associations, it's usually in your bylaws, says that members get to see or inspect or even copy books and records of the association. There's a statute in North Carolina and in South Carolina that very strongly implies that members are entitled to see the books and records of the association. Right? Now, that's going to include some financial records. And here's where I'm going with this. Profit and loss, yes, absolutely. Balance sheet, yes, absolutely. General overview documents, you know, where you are budget compared to actual expenses for the year, most likely, yes. Okay. But they don't get to see the canceled checks, the general ledger, all the contracts in the association. You know, that's what most, well, not most, but that's what a lot of angry homeowners ask for. When they're upset about things or they think the board's doing the wrong thing, I want to see the last 10 years of everything the association has spent money on. I want to see the general ledger for 10 years. I want to see canceled checks, bank statements. I want to see it all. Okay. I'm telling you that that's not typically available to all the members. Okay. Are those books and records? Yes. Are they entitled to see kind of some low-level information very easily? Yes. Okay. So if somebody asks for 3 years of the profit and loss, balance sheet, and the general, you know, budget versus actuals, yeah, okay, freely given. Okay, for 3 years. If they want more than that, then they're going to have to provide a good faith reason and proper purpose. Okay, and that's in the Nonprofit Act. We're not trying to obstruct their review. We're just trying to keep it, you know, keep it reasonable, and have them tell us what a good faith reason and proper purpose is. Now, my experience has been, we give them this form. We have a template form that we give these homeowners who are asking for records, and it forces them to give us their good faith reason and proper purpose, spell it out for us. We get it back. I'd say 8 times out of 10, it's not a good faith reason or it's not a proper purpose. Okay. And so that's not something we're typically able to give. And let me break those apart. A good faith reason for the request. Do they have a good faith reason? Okay. And a proper purpose, what are they going to do with the information? That's a separate and additional requirement. So give you an example. My car got towed, and I want to see the books and records of the association of every car that's been towed for the last 10 years. Well, no, you can't have 10 years. We might talk about 3 years, but here, give us a good faith reason and proper purpose. Well, the good faith reason might be that I just got towed and I just want to make sure everybody else is being treated the same. Okay, that's probably a good faith reason. Proper purpose. What are they going to do with this information? If we give them 3 years worth of records of people we've towed, what's their purpose? And so that's usually where we kind of hit the wall a lot of times. But that's a very, very common question that we get. All right, next topic, association loans. I'm not a big fan of borrowing money. Okay, I'm not a big fan of my company's, my association clients borrowing money. But if you have to, you have to. And sometimes you do. Sometimes you have to. We try to avoid it for obvious reasons. Interest you have to pay. It may tie up some marketability issues. You know, if somebody wants to buy a condo unit in there and they find out there's this big loan out there, maybe the bank won't loan on that. You know, I think Chuck touched on that a little bit. If you are going to have to use a loan and get a loan, then tip number 1, use a bank that focuses on HOAs. Please, please. They're out there. If you need a recommendation, come ask us. We know who they are. Because the ones that don't work with HOAs, it takes me forever to basically rewrite their loan documents. And you have to pay for that. The association has to pay for me to rewrite them and then teach the bank why I had to rewrite them. So go to the banks that help HOAs. Their forms are very good at this point. We've done so many of these, and other lawyers have helped these banks too, that we've kind of nailed, flushed out all the questions and problems. And so once they use that great form, should be easy. Okay. Number 2, banks want collateral. Okay, they always want collateral, and they should. Collateral is usually your operating account, your bank account for the association, the reserve account. They want to use that as collateral also, and they want the right to go collect future dues from homeowners directly if you default. Okay, so that's the most common collateral that I've seen recently. That's okay. Could they come and drain the operating account, drain your reserve account, and go demand payment from our homeowners for future dues if we defaulted on the loan? Yes, they could. Okay, that's the collateral you're giving them. I've not seen that happen yet. Okay, in many, many years of doing this. So they'll work with you long before they pull the trigger on those kind of drastic collection methods. Collateral is rarely real estate. Okay, it used to be, they wanted a lien against the clubhouse. They wanted a lien against the stables that you have, or whatever the real estate is you have. They wanted a mortgage, basically. I haven't seen that in a long time, but it could still happen, depending on the size of the loan. So watch out for that. The trap for loans is this. There may be a membership vote requirement to pledge that collateral. In other words, if the bank requires that you give them the operating account and the reserve account and the future assessment revenue as collateral, your governing documents may say you have to get an approval of the membership of 75% of your members, or a majority of your members, or a majority vote at a meeting. I mean, there's all sorts of different variations out there. I can tell you with a very high degree of certainty that if you have to pledge real estate, if you have to pledge the clubhouse as collateral, you are going to have a membership vote. And it's probably a very high membership vote, likely upwards of 80% or more. Okay. Now, the reason I'm telling you this, and it's such a big point for me, if you have to get a loan, you've already talked about it. You've already talked to a couple of banks that do HOA work. You're ready to go. You know what you need and you want. That needs to be the very next thing that you do, is figure out if you have to get a membership vote or membership involvement. Okay. And get it if you have to. Go get it, and then we can move forward. What I mean is, I've had situations where the association doesn't come to me until they've already negotiated everything, the documents are prepared, and they want to close on Thursday. Well, I look at their documents and, well, you got to have a meeting of your membership. You have to get this certain vote of the membership to pledge this collateral, and everything comes to a grinding halt until we get that. And worst case scenario, we don't get it. And if you don't get the vote to pledge whatever collateral may be required, you're not getting the loan. So don't go too far down the road of a loan without knowing what membership vote might be required. That's the point. All right, most association loans are a draw, which means you got $500,000 available and you draw on it and pay the contractors. So you've got a roofing project. Well, draw money out, pay them as they go. Often, I've seen them where there's 12 months of interest-only payments. That's kind of nice. And then after that point, that balance is amortized over 3 years, 5 years, 7 years, or 10 years. Okay, so let's play that out for a second. You got a roofing project. You got your money, you got your contractor, the expert contractor, to come out. They start working, you draw money off. You pay them $100,000 here, $200,000 there, $100,000 there. Hopefully within 12 months, they're done. And you know that you had to borrow $450,000. Well, then that balance is then amortized as payments over 3, 5, 7, or 10 years. Okay, so that's usually the way HOA loans will work. Big hurdle. Most associations that need that kind of loan, you know, a couple $100,000 for something, they don't have the money routinely to make that payment. Okay, so you borrow, say, $500,000 for 5 years, you know, your loan, your payment's going to be several $1,000s a month. And so if your association doesn't have several $1,000s a month, which it probably doesn't because it's having to get a loan, then you're going to probably have to get a special assessment passed by the membership. Now, special assessments almost always require a vote of the membership. It's usually 2/3 of the entire membership has to vote, yes, I'm in favor of, and I will pay a special assessment of $3,000, $5,000, $10,000, whatever it is per home. Okay, so that's another trick of don't get ahead of yourself. Okay, you need to have that special assessment already done, the vote already taken before the bank's going to close and give you the money. Right, so very important to know what vote you need, try to get it before you start doing the loan. Now, watch for, and this really gets into the legal weeds of it, but it's so important that I want to take a minute. Watch for the immediate assignment of collection rights. Okay, now what this means is, and we've kind of, like I mentioned before with the HOA banks, we've kind of flushed this out of all of their documents, but it may pop up. What it means is the older documents from banks used to say that when the president signs the loan documents at closing, that they are assigning the association's rights to collect dues in case of a default. Okay. Now, we talked earlier that, yeah, they're going to have that right, but the older documents have an immediate assignment of those rights. So as soon as the ink dries on the president's signature, arguably all of the association's rights to collect money, the dues, have now been assigned to the bank. And you can see why that might be a real serious legal problem, because then we as the association may not have the right to collect dues anymore legally because we've assigned it to the bank. So we've, again, flushed that out. That's now in all the new documents, only triggered once we've defaulted on the loan. So we get to have all the rights to collect our dues until we default on the loan, and then it's automatically triggered over to the bank so they can do it, which again, hasn't happened in my career. One of the other things about association loans is there's an opinion letter that every bank requires. It's about 3 pages long. They have a nice template that they give us, which is basically us as the lawyer for the association saying that we've checked everything, the special assessment, if one was needed, was done properly, the right vote was done, that, you know, the board of directors has the authority to sign this loan, take this loan, you know, just a lawyer's opinion from the association saying this loan is good and all of the collection rights, if we default, are good. That can cost the association between $1,500 and $3,000, depending on how they draft their template form, but just know that that's part of the expense of the association if you're going to get a loan. And the banks will tell you that up front. All right, switching gears. Last topic for me today, the Corporate Transparency Act. If you haven't heard about this already, it's a big piece to what's going on. The federal government passed a law, Congress, a couple of years ago, the Corporate Transparency Act. It got triggered on January 1 of 2024. Okay, so last January, it became law. What this law requires is that for all corporations, nonprofit, for-profit, LLC, for all corporations, the beneficial owners, which is really the board of directors, you guys, okay, the board of directors of corporations, HOAs, will have a duty to register certain information with the Financial Crimes Enforcement Network, okay, called FinCEN for short. So Financial Crimes Enforcement Network, FinCEN. You have to register your legal name, your date of birth, your home address, okay, not your business address, not a PO box, but actually where you live, and upload a government picture identification, your license, most likely, okay? The purpose of the act is to fight crime, okay, mainly money laundering and fraud. So the government has basically, the federal government has basically said, we need to catch these shell corporations that don't really have anybody, driving the bus. We need to catch those people from committing all these crimes. And so we're going to throw out this enormously broad net of all corporations. I shouldn't say all. There's criteria. I think it's if you have more than $5 million in revenue and more than 20 employees, you might be exempt, but almost every association is going to be bound to this. So the government said, we've got to be able to look under the hood of these corporations and see who's driving the bus. Okay, that's what they're doing. And that requires homeowners association board of directors to register their name, date of birth, home address, and upload a picture of your photo ID. Now, don't everybody panic, okay? Because of three reasons. One, if you are a pre-January 1, 2024 association, which means you were incorporated with the Secretary of State before January 1 of 2024, which is almost all of you, you have until December 31st of 2024 to do this, okay? So you got all the entire year to do this. And we, at our firm, are advising our board of directors not to race out there and register yet, okay? You've got all the way until the end of the year, and we're hopeful that they'll change the law. They'll carve out associations, or they may delay the entire act completely, or there might be some legal challenge to the constitutionality of the act. And so if you were on a board of directors of an association that was created before January 1, 2024, you have until the end of the year, but I'd wait until probably the late third quarter, early fourth quarter to start asking questions about it. Now, if you're a newer association created after January 1 of 2024, so just this last January, created with the Secretary of State, you only have 90 days to register, okay? Now, that's going to be mostly developers. I mean, they're going to be the only people on the board of directors at the time, and their lawyers should be helping them get that done, all right? So the penalties for not registering are significant. There's a $500 per day financial penalty, and it's a misdemeanor. I think it's a misdemeanor. There's a criminal side to it as well, okay? But again, please don't worry about it because it may be delayed, carved out, and not happen at all. In fact, there was a case that just came out 3 weeks ago, maybe 2 weeks ago, from the Federal Court of Alabama. I think it's Northern District of Alabama, where some board of directors sued and said that the Corporate Transparency Act was unconstitutional. Okay, now that court ruled that it was unconstitutional. Okay, but within about 4 days, FinCEN came out with a press release that says, yes, we know about this Alabama case, and yes, we cannot enforce the Corporate Transparency Act against those plaintiffs In that Alabama case, we recognize that, FinCEN said, but FinCEN also said, but we interpret that case to only be about those plaintiffs, and we're coming after everybody else. Everybody else still has to comply. Okay? But that case may be appealed to the Supreme Court, and the Supreme Court may rule the same way, or another federal court may take up a case and push forward. And so there's lots of stuff that could happen that could make this act go away for our association. So I don't want you to worry about it too much. My last point on the Corporate Transparency Act is, even if we do have to comply, truly, even if the board of directors of an association has to register date of birth, home address, and name, date of birth, home address, and upload a picture from your license, the government already knows that. I mean, it's on your license. Everything that's listed here is already on your license. All you're doing is telling the government that you are on this volunteer board of directors. That's the only new thing that they're going to know because of this registration. So I would submit that it's not that big of a deal because they already know who you are anyway. You're not giving them any new information for that. All right, so that's what I've got for you today. Board of Directors duties, loans, Corporate Transparency Act.
Excellent. And if anyone would like to see a full hour-long presentation about the Corporate Transparency Act that Steve summarized in about 5 minutes, you can. We do have a webinar on that. That was done, I think, in October, November timeframe. So it is on the CAMS MGT website. So the first question that we had, and this is one I can probably answer, is how much should we expect to pay for a reserve study or a reserve plan? And so we are actually doing another webinar next month with a company called Reserve Advisors. So they're going to be talking a little bit about the, reserve studies and reserve plans. So they can talk specifically, depending on the size of your community, you're probably looking between $2,000 to $5,000 for a smaller community, and then upwards between 10 to 15 for a very large community. So that would be just the basics on a reserve plan, but we could certainly talk more about that. Stephen, another question that came in had to deal with our documents say that we are required to do audits, but we have not done audits in the past. Do we have to do one because our documents state an audit is required?
The answer is yes. And I get the opportunity to say this in almost every presentation I ever do. When there's something in your governing documents, no matter what it is, the board has two choices. Number one, follow it or enforce it as written. So if yours says you have to get an audit, you got to get an audit, or amend it and change it. Those are really the two options. And in fact, I have a litigation case right now. There's lots of claims in that case against a developer community, and they black and white says had to get audits. They had not gotten an audit ever. And that was one of the claims they added to their lawsuit against the board of directors is failure to get the audit. So yes, I have to advise that you get an audit.
Okay.
Or amend.
Or amend. Eric, this one may be for you, and you talked a little bit about it. We want to depreciate our clubhouse on our balance sheet. Why do you not do that?
Because the clubhouse is common property and it is not on the balance sheet. It's just I mean, it's really just that simple. Common property are expenses that go onto the P&L.
Right. I would.
And Chuck can elaborate a little bit more.
Yeah, I would elaborate that reserves and setting aside repair and replacement in CPA land is a way better way to provide for repair and replacement of the clubhouse. And that's why CPAs want you to do a reserve study and set aside money to do it, to satisfy your fiduciary responsibility. Making a entry for depreciation does nothing to setting aside money in your war chest to replace that clubhouse.
And there's no tax benefit of that either. because
Well said. Yeah.
and it's all a related exempt function. So there's no tax benefit to depreciating it.
Remember, yeah, we can't deduct that as an expense of the business because it's not within our mission statement. But setting aside reserves for it is, and that's our recommendation.
Okay. Steve, you had talked a little bit about self-interest. Is that the same as conflict of interest, or self-dealing? And is that the same as conflict of interest?
Yes. Not exactly the same, but very, very close. Yes. Yeah. For example, self-dealing, I envision that more of I'm benefiting as a homeowner because I'm on the board of directors and I'm doing it on purpose, versus kind of a conflict of interest would be if I was trying to steer the board to use my cousin. That's more of a conflict of interest because I may not benefit from what my cousin gets. Very similar though.
Okay. Chuck or Eric, we're in the middle of tax season for associations, and I will say that we handle probably 90% of the work to get that information over to you guys. Any comments on tax prep and meeting the deadlines of April 15th? I know you're knee deep in it right now.
Well, as Chuck mentioned, the vast majority of forms that are filed are the 1120H, which is a very simple form to fill out. Most of the information we get from that is financial statements and 1099 INTs. And through that process, we look at the interest income. As Chuck mentioned, the interest income is the biggest driver of taxable income, especially now with the CD rates being 4 or 5%. The biggest thing that we are seeing that is we're having more potential associations potentially having an option to switch to the long form 1120 because of $40,000, $50,000, $60,000 of interest income, where there might be a benefit to them switching to the long form. That's really what we're seeing more this year. More than anything is that increased interest income driving more taxable income, and more associations are paying even just a little bit of tax this year than have in the past. But like Chuck said, the interest income, you earn it on that money sitting in reserves that you're saving up for your clubhouse repairs and such.
I would say that someone who's knows what they're doing and has done a bunch of them, as Eric said, it's easy. For someone who wants to be the nice board member and do the tax return, one of the worst ideas I can conceive of, because you don't know the nuances of all this. And I've been on many boards also. It's tempting, but it's a huge exposure for the board. I can tell war stories with others about personal liability to board members because they messed up all this sort of thing. So it is an area to use good judgment of someone who works on it a lot, just like you use the attorneys when you're dealing with anything that requires specific judgment.
And let me jump in there because, one of the first things I said on how to stay out of trouble is to use experts. And that falls right in there. Otherwise you kind of strip away your good business judgment, you strip away your good faith, you strip away those protections.
And the abuses we see doing audits are almost always embedded in self-interest, conflict of interest, and it can cause horrible situations for other board members and owners in the association.
Okay.
So that was a very important point.
I see somebody with their hand raised. So if you could type that question into the Q&A feature, we can help answer that question. Steve, one of the questions any update on either the North Carolina law and now the new proposed South Carolina law that is looming for associations? Anything you can share on either?
House Bill 542, I think is what they're talking about in North Carolina. And I will say, you know, Harmony Taylor in my office, 4 offices down, she is the chairperson of the NC-LAC, Legislative Action Committee. So, you know, we've got a front row seat to what's going on with this. Currently, nothing has happened. Nothing has moved. There's still some discussion in the background, but we can't say whether something's going to be passed this session or not. Things have certainly slowed down on those discussions, and good discussions on both sides with this. But no, there's no kind of recent updates on that. South Carolina, amazingly enough, David Wilson, another one of my partners here, 2 doors down from me, is the head of the South Carolina Legislative Action Committee. And there's nothing big in the hopper there. There is some discussion about a bill that I'm not sure if it's been proposed or not, or just being discussed, that would restrict an association's ability to foreclose, to collect dues in South Carolina. Now, I don't want everybody to get excited about that because it's something that just came up, and you know, there's a lot of people talking about it, but nothing's been formally proposed.
And I would just interject that the CPA lobbyists, we had a private conversation with him about the HOA Act, and his take will be it is highly unlikely to pass. And like most good CPAs, we worry about laws once they're passed, because a lot of these, there've been legislative acts in North Carolina for many years about HOAs, and none have passed. So when it's passed, I will be all over it.
So Chuck or Eric, this may be for you, but I'm trying to resolve a startup money issue. I'm assuming that may be from when the developer came on, or it's been on the balance sheet for about 10 years. What are the options, and is it something that we need to be concerned with to clean that up?
I would have to see the balance sheet and understand the context in order to provide guidance. It seems like a very specific, that's a very singular association specific matter.
Yeah,
Okay.
but has the developer turned over control to the board? That should have gone away a long time ago. So it sounds like a developer issue, and the developer may still be in control of that association. So the current board probably has little, would have to talk to the developer about what that is.
Okay, I've got 3 more questions. We're slightly over time, so if y'all are good, I'll ask these 3 questions for everyone that needs to leave or wants to leave. Feel free to leave, but I will ask these remaining 3 questions. So, can we pay out of the reserve on pool step repairs or other general maintenance that would maybe be a normal operating type item?
So the pool step repair, if it extends the life of the pool for a significant period of time, the answer is yeah, because that's a capital item. You have your pool. That sounds like a pretty significant repair related to the pool and its functionality. Now, regular pool maintenance, such as cleaning the pool and changing filters and such like that, of course, that would come out of operating. You know, so you kind of have to look at it that way. So hopefully that answers the question.
The IRS says if it's capital under the IRS code, if you'd capitalize it under your capitalization policy, if it's, like Eric said, extends the life or lasts over 2 years and is a large amount, that's what it has to meet, is the IRS requirement for a capital item.
But it sounds like it more than likely would be in the pool step, more than likely would be.
Yes.
So this next question, very general, probably could be answered a couple of different ways, but how do you decide whether to pay an expense from reserves or operations? And Steve, I don't know if this could segue into budget discussion, but there may be certainly some IRS regulations. So who would like to tackle that one?
Well, I'll say first that just from the operational perspective, if you've budgeted for it, you probably should pay it out of operations, generally speaking. You know, if it's a reserve item such as improving amenity center, you know, replacing the floors in your clubhouse or the countertops or putting new fans in, you know, if you're going through a whole upfitting, then that would be a reserve expense. But like Chuck said, you know, it's got to fall under the rules for capital under the IRS. But generally speaking, in my opinion, if you've budgeted for it, it should be paid out of operations.
But I'd also say that the income statement under CPA guidelines is supposed to be an all-inclusive income statement generally. So a hurricane loss, a fire, things that are unusual still would have to come out of operations generally, just because that you had a big insurance deductible or something would not entitle you to take it out of reserves, because
Well, capital reserves, because you could create a non-capital reserve for a like an emergency contingency, like a storm cleanup or insurance deductible. The board could create that board designated non-capital reserve for that.
True.
So last question, we live in a hurricane prone coastal community. Should we consider a separate emergency fund, or can we use reserves to pay repair damages to common property that is damaged, like a pool, playground, or trees?
Chuck, do you want to take this one?
It's lots of fun. You can temporarily, if you temporarily need emergency funds to take care of a hurricane loss, you can borrow from reserves, but you would have to have a repayment plan to pay it back. So that's the best answer in the short term. Having good insurance is a second good example. Many things are not reservable that a hurricane would do, like replacing trees that are, you have to take and remove trees, $2 million worth. Well, that's not covered by insurance, and it's not even a common property thing. It's just maintenance and cleanup. And so you're stuck in operations.
And that's why I mentioned there's a lot of benefit to creating, especially in our area, having a non-capital reserve or board designated reserve to set money aside for storm cleanup and insurance deductibles, that you would have the money there and you wouldn't have to worry about whether it's capital of operation or operations, because you've already created that non-capital reserve.
Yeah, and having a hurricane plan is essential. So I know CAMS is experts at putting those together, but in our area, you have to have a plan, and it's the difference between disaster and a managed cleanup after a hurricane.
Steve and I are both inlanders, so we don't have to worry as much about the coastal issues, but knock on wood, there were no hurricanes last year, right? So
well, let me tell you that I lived at Wrightsville Beach during Hugo, and I made the big mistake of going to Charlotte.
Yeah.
And you guys had a big problem during Hugo. I came home to my house in Wrightsville Beach, and the tennis shoes in the driveway weren't even wet. So don't dismiss this.
True, very true.
Yeah, it could happen.
So, well, thank you all. Thank you, Steve, Chuck, and Eric, for joining us tonight and helping lead the webinar. As I mentioned earlier, our next webinar is going to be with reserve advisors, all about reserve studies. So the next, April, the third Thursday in April. So with that, I will say goodnight and thank you again for joining. The session will be recorded, or has been recorded, and will be posted probably Monday or Tuesday on the camsmgt.com website under board members. So thank you and good night.
Thank you.
Right.
Thank you.
Night.
Bye-bye.